So, the problem with Voyager is that all of the risk is mispriced. It's funny. I was just listening to another Twitter space, and they were talking about how we really need regulation. We need the SEC. We need, you need to contact your representative, contact your, and it's all of a sudden now the SEC is like our hero, right? We need the SEC to bail us out. And I really don't think that's the answer. I mean, of course, the space does need regulation, but the answer is really to have proper economic analysis of how and where these platforms are generating their yield. Nobody knows who to listen to. You got Matt Damon, fancy advertising, saying everybody, come to crypto. It's great, but where do you get the actual analysis of how these platforms are generating their yield? Is it sustainable? What's the leverage point where they're going to go under? And so today I want to talk a little bit about why Voyager went under and what people could have done differently. I'm sure you guys know by now that Voyager is just filed bankruptcy. So the whole problem with this is mismanaging risk. Like when you guys go out and you buy a crypto or a small cap, it's risky, right? You just know it. You go, well, I've heard that 99% of cryptos are going to go away, and I'm going to throw $100 in there, or $500 in there, or something. And if it goes down 80%, you say, okay, well, that was risky, right? And if it 10x's, you say, oh, that was cool. I took a risk and it paid off. I'm going to take profits. The problem with Voyager and Celsius and these other platforms was they were marketing themselves as safe passive income, as a platform where you could earn some sort of income return on your crypto. And so that made people think about it and categorize it in their mind as a bank. I mean, Celsius even said unbank yourself. So it was this whole marketing campaign of this is the banking alternative. So I have a lot of friends, I know a lot of people who, they didn't have $500 on Voyager, they had 5,000 or 50,000. And so they were sort of misled. And I'm not saying that anyone misled them on purpose, but the whole marketing push for Voyager and Celsius, the whole idea behind it was this sort of subtle idea that it was the alternative to a bank and you could just sort of stick your crypto on there. Behind the scenes, what these platforms were doing to generate yield was they were lending out your crypto to hedge funds that were making risky degen plays, and they were investing in tiny micro cap crypto startups and randomly just sort of throwing spaghetti at the wall. So it's really a case of mispriced risk. And what we really need to be talking about here is who are the economists. I'm an economist. My friend Caleb Franzen here on Twitter is an economist. There's a lot of economists, but who are the economists who are keeping track of and telling everyone, economically speaking, what the risk is of how these platforms are managing our money? And I think that's what you're going to see in the next bull run, or the next iteration, the next format that crypto morphs into. I mean, we all know that now there's going to be regulations coming in, but what's the next batch going to look like? Well, obviously there's going to be regulation, but I think more than that, we're going to highly value proper economists who are crypto economists, and they can take a look, they can audit these platforms, and they can say, oh man, if you want to earn yield here, this is the risk profile, right? I mean, all of these different ways of earning yield, earning passive income have a different risk profile. Staking and validating a network has a different risk profile. Running a node has a different risk profile. Centralized yield platforms have a different risk profile. So, what is the risk profile of the platform that I want to use? And people need to go into these, with their eyes wide open, knowing what they're getting themselves into. So that's what I wanted to hop on here and talk about was how inappropriately uh, priced risk was in this situation. I mean, it would just be the same thing as if you put your money in Bank of America or Wells Fargo, and you come to find out that they're loaning your money out to dog food company startups that are hoping dogs will only like, carrot flavored uh, dog kibble, and that's where all your money's going to generate the yield. So that's kind of what I wanted to hop on here. Does anyone want to say anything or ask any questions about Voyager? Or I guess that's the format of this spaces, is that people can chat. I think we might actually have some other speakers and hosts coming on here. I'll have to see if they got back to me. But does anyone want to ask any questions about Celsius or have anything to say about it while we're here? See if I can see who raises their hand. But anyway, I mean, yeah, that's the fundamental problem. I come from a business background of economics, and I just couldn't believe that people were not asking for the return mechanisms on Voyager and Celsius to be audited. I kept asking all of 2021. If you guys watch my videos and follow me on all my platforms and Instagram, TikTok, whatever, you'll see that it was driving me crazy. I was having like a nervous breakdown, not knowing how Celsius, how Voyager were generating their yields. It was literally driving me crazy, and that's a question that going forward now, people are going to need to know up front. And that's actually one of the purposes of regulations. When we talk about needing the SEC to regulate, what we're really saying is transparency of how these companies are investing your assets in your funds. That's exactly what the SEC does in the stock market. They require companies to file quarterly and annual reports that show exactly how they're managing their balance sheet, how they're managing their assets, where the risk is. And then you have smart people who write articles and analysis and translate that data into what the consumer can understand. And that's why you read the Wall Street Journal, or you read you watch CNBC, and you watch some smart analysts say, oh well, you shouldn't invest in this company because they have this risk exposure, right? No one was doing that for Voyager and Celsius. You put your money in, and it went into a black box, and then there was some yield, quote unquote yield, being generated, and nobody knew how risky that yield was. And the fact that they were misleading people, not necessarily on purpose, but thinking of it as a bank, as, oh, this is a safe place to put my crypto, is very, very misleading, because banks in the real world have FDIC insurance, and they have, when they're lending your money out to generate yield in the mortgage market, there's collateral on those loans. They can foreclose on houses to get their value back. So this was just the whole root of the Celsius and Voyager problem boils down to mispriced risk. The consumer was not aware that they were using their crypto to make degen small cap, micro cap plays by having Celsius and Voyager lend out their crypto to hedge funds. It was a mispriced risk, and it was 100% the fault of these platforms, who were not transparent about how they were generating those returns. So I just wanted to hop on and talk to you guys about that. Oh, it looks like we have somebody who requested to speak. Let's see if I can figure out how to get this person up here. Add as speaker. Here we go. Hey, Vamsy, how's it going? Good.
You said in the next bull run, there will be a lot of regulation coming in from SEC. Um, how is that? How do you think that is going to affect the yields? How is that going to affect the returns? And if the returns are not as good as we've been made to believe, then what do you see the future of the crypto industry after that?
Yeah, that's a great question. I mean, it's by definition, the yields cannot be as high anymore after this, because you cannot generate safe yields in the 5, 6, 7, 10, 20%. It just doesn't exist. There's no such thing as a safe yield that is that high. I mean, it's You can get a higher yield than in banks because there's less middlemen, right? The banks, the CEO's flying around on a $20 million jet, so some of the yields going to that guy. So you actually can get higher yields than traditional banks. But the reason that Celsius and Voyager were drawn to um, being so risky and degen plays and everything was because it was the only way they could get the yield. That was the only way they can do it. In a sense, crypto is a house of cards that all of this yield is generated based on trading fees and staking, but all of the staking and the trading fees depends on more staking and more trading fees. In other words, it's just kind of this big snowball that got out of control. You still can have legitimate DeFi in crypto. You can lend out your crypto. You can have collateral, have your crypto as collateral. I think the yields will be down quite a bit, and we're gonna have a whole new batch of platforms. I mean, it's over for Celsius and Voyager. Even if they get bailed out and put back on their feet somehow, that no one's ever going to trust them again, right? I mean, with a bank, once the trust is gone, once it's gone forever. So all of these platforms that have gone under now are gone forever. You're never going to hear their name again. People just are not going to be like, oh yeah, let's just give Voyager a second chance. That's not how it works. So the next batch of lending platforms, if there even are any, um, they will be regulated, they will be transparent, and the consumer will know what the risk profile is. So that's my best comment on your question there. I hope that helped.
Yeah, that did. I have another question though. Is that okay if I ask one more?
Yeah, yeah, absolutely. This is just kind of a hangout here.
So, that said, I've been following Nexo, and Nexo has not gone under, and it's just been promoting these inflated, I'm guessing, interest rates. So I'm wondering, what is there any information about Nexo? Because I have a decent amount of money in Nexo, and I'm wondering if I should pull my
Yeah.
money.
Well, no, that's a great question. I mean, I don't want to start any kind of panic, so I don't really want to talk about individual platforms and which ones might go under. But I think a general comment that can help you is that you absolutely want to get your crypto off of exchanges right now. And again, it has everything to do with pricing that risk because, in the next 2 to 3 months, we could see a lot of platforms go under. And in 2 to 3 months, you're only getting, 2 to 3 months worth of yield, worth of return. If your annual rate is 10% on whatever yield you're getting, you're getting 2 or 3% of 10%. So you're getting 2 or 3%, or not 2 or 3% of 10%, but 2 or 3% total in the next few months. And so if you have, $100,000 on there, you're getting $2,000 of passive income over the next 3 months. Is it worth risking $100,000 of crypto over the next 3 months to get $2,000 back? Of course not. It isn't. And so that's why, I mean, I think everybody needs to get their crypto off of exchanges. Even if you have to sell the fiat and get it back in your bank account because you don't know how to use a hardware wallet, that's still better than leaving it on exchanges and platforms. Um, I cannot emphasize enough how bad this contagion really is. None of these platforms have enough crypto, have enough assets to pay everyone off at the same time. That's not how it works. They only keep a small amount of liquidity in the near term to pay off depositors if they want their crypto back. And all the rest of it is lent out into the market, and none of it is liquid right now. You can't get any of it back because everywhere they lent it, they don't have it. They're all of their valuations are down. They're getting liquidated. Going into bankruptcy. So yeah, it's really, really, really bad. It is so bad right now. I mean, people do not understand just how bad this is. It's a death spiral. It's a death spiral in the entire crypto lending industry, and the only way that we're going to see it bailed out. It's so funny that we're talking about bailouts here because in the 2008 financial crisis, all the banks had to be bailed out. It's deep pockets, like as we're seeing with Sam Bankman-Fried and Binance bailing out a few of these platforms. Now, why are they bailing out a few of these platforms? Two reasons. Number one, because they want to sort of preserve the sentiment in crypto because you run FTX or you run Binance, and a tiny little platform that's only 1% your size, like Celsius, can have a huge impact on you as Binance or FTX. It's negative market sentiment. So they're trying to prop up the market sentiment a little bit. And the second reason is they're buying these, crypto platforms for pennies on the dollar. They're buying, liquidation sale, basically. I've seen this in the stock market for years. Company goes bankrupt, all of their assets get put up for sale to pay off creditors, and the assets sell off to the highest bidder. And in the 90s, there was a self-storage company that went bankrupt, and there was another company that came in and swooped up and picked up all the real estate for pennies on the dollar. And now it's one of the biggest self-storage, most profitable companies in the whole stock market. It's called Public Storage. It's a $100 billion company, and so that's what's happening in this case. But my answer to your question is yes. Get your crypto off exchanges. The risks cannot be overstated.
Thanks, Brian.
Yeah. Anybody else have anything they want to ask or mention with regard to Voyager, Celsius, the systemic risk in these lending platforms? It was never really disclosed, and I'm not going to be a jerk about this and blame anyone. I mean, ultimately, it's really the platform leaders really do have a lot of responsibility. It's not that they shouldn't have been taking these risks, right? It's that they should have let people know. When you go onto the website of Celsius and you see it looks just like a bank, it says unbank yourself, your deposits are safe with us, you can withdraw your crypto at any time. It's misleading because the customers didn't know what they were doing with those funds, right? They didn't know that those funds were going to be lent out into straight up degen, risk on, low likelihood of success um, situations. They did not tell us that. And so, as an old school economist boomer myself, I had the hair on the back of my neck standing up saying, wait a minute here. I want to read your disclosures. I want to read your audit. I want to know um, how you're generating this yield. And I made videos about this last year, and people laughed and clown emojied me and said you don't know what you're talking about. And I was like, look, I want to be proven wrong. I want to be proven wrong that that this is a safe thing, but I need to see um, where these yields are being generated. I need to see. Okay, hey Michael, how's it going?
Hey Brian, not too bad. How you doing today?
Good.
First of all, I just want to thank you for always sharing like really valuable content with the followers and everything else. I just had a quick question. What is the difference between crypto.com and Celsius?
Yeah, that's a great question. I mean, there's no difference really. I mean, the platforms basically all have the same business model. They make a little bit of money on the yields. They make a little bit of money on trading fees. So, I mean, crypto.com, what's going to matter in this situation is who has the liquidity to stay alive for a while. And I think crypto.com is not in danger. I personally don't think crypto.com is in danger. They're a lot bigger. They have a lot more liquidity. Were they taking the same kind of risks? I don't know. That's the whole problem. That is the whole problem with the industry is they are not disclosing how they are generating these yields. But when I did research on this a few months ago and I read as deep as possible into the disclosures of a lot of these lending platforms, I was blown away by how risky it actually was and how lack of transparency. And you would sign on, and one day later, their disclosures would change. They would add some language, and they wouldn't necessarily notify everybody. So the difference between Binance, FTX, Crypto.com, and Celsius is basically nothing except deeper pockets. Better money management. So Binance, FTX has very deep reserves. They have a lot of cash. They have a lot of liquidity. They might have enough cash and liquidity to survive anything that can come, right? Like it is possible for a company to manage their cash well enough that when the crap hits the fan, they can keep operating for 5 years. And that's the question is that everybody's wondering right now is who has the cash and the management and the de-risking and who doesn't. And I don't know the answer to that. And I don't think anyone really knows the answer to that except for 10 people who are, watching the next one explode right now. And this is why it's so important to get your crypto off of exchanges. And even like I said before, even if you have to go into fiat for a while and not even have any crypto for a while, it's better than losing money. Warren Buffett said the first rule of investing is don't lose money. The second rule of investing is don't forget rule number one. Um, you never want to lose money in investing because it's much harder to make back a loss than it is just to start over from a break even, right? So we do not know what the systemic risk profile is on a lot of these lending platforms. They're not regulated. They don't have to disclose how they're making that yield. It's just a black box. It's like watching a magic show. You put money in on one side, yield comes out on the other side, and you have no idea what they did to get there. And as we've been seeing now, they've been lending out your crypto to degen, risky, small cap, micro cap hedge funds. It's basically just an absolute disaster. So I hope that helps. Hope that answers your question. Hey, Weatherman, we got Crypto Weatherman in here. Let me know
Thanks,
if you want to.
Brian.
Yeah, no problem, Michael. Let me know if you want to hop on here, Crypto Weatherman. I just thought this would be an interesting topic. I mean, I eat this stuff up as a kind of an old school economist, and I don't want to say I told you so because that's not really my purpose. It's just fascinating that the industry allowed this to happen. The industry, allowed this kind of lack of transparency to happen. It's just crazy.
Hey, Brian. Thanks for having me. Good talk. I just hopped in a few minutes ago and completely agree with everything that you said. All these, and, anytime I saw anything offering more than like 2 or 3% in terms of APY, it always made me scratch my head because I think of like these major companies generating billions in revenue, and those dividends are quite minuscule compared to what the crypto space was offering. And I'm just like, where are they getting this? And this has got to implode at some time. So, we didn't know when it would exactly happen until it actually happened. But yeah, completely agree with you. I think something that's been on my mind is after seeing the liquidity issues, particularly with these smaller hedge funds, these smaller lending platforms, and I say small relatively speaking, you know, I I also wonder if like these medium-sized exchanges are going to experience the same thing. Uh, and what's got me thinking is we think about traditional platforms like TD Ameritrade, Fidelity, that generate literally, I think Fidelity is like over $20 billion in revenue and stuff like that. And we see them, getting their feet wet into the crypto space. And we compare that to even your medium-sized exchanges like Coinbase, I think is somewhere around 1 or 2 billion in regards to revenue. So like, even though they have in Binance, like they have deep pockets, those deep pockets compared to like the entire financial industry are still relatively small. Um, so it makes me wonder: is there something bigger that could pop? Even those, at least the medium sized exchanges down the road. I don't know the answer to it, but it's something I contemplate often.
Yeah, I mean, it's really like we're in the dark ages where, a run on the bank can actually happen. A run on the bank is one of the most destructive things for an economy. It's really a horrible thing. And we solved it with conventional banking by having FDIC insurance. So people know that, oh, I don't really need to worry about my money in the bank. If they go out of business, I'm going to get my money back. When you don't have that safeguard, um, you you're exposed to a death spiral of contagion where more and more people don't trust the system, and then that just spreads and spreads. And so it really can bring down. I think you're right. I think it can bring down medium sized exchanges, and some of these other ones, even the larger ones, are going to may face a point where they might not be brought down directly, but they might decide to close their doors and preserve what little net worth liquidity they still have left. So it's as bad as you can imagine, and
Mm-hmm.
worse when there's a bank run.
Yeah, you mentioned FDIC. I was probably a few days ago. I was looking at what all crypto exchanges were FDIC insured, and interestingly, Voyager was on that list. The other ones, I just pulled it up: FTX, Coinbase, Crypto.com, eToro, Gemini, Luno, Paxos, Robinhood, and then Voyager was at the bottom. But we all know that the issues that Voyager is experiencing, it's going to be interesting to watch and see how that plays out. From what I gather, is they're just restructuring their debt. So they'll continue to operate. So I think there's a light at the end of the tunnel for those utilizing Voyager. It's just it's going to be a nerve-wracking time while they're doing that transition with their Chapter 11.
I mean, yeah, it's an unknown, and I do think that some of these ones that at least had some decent level of management can eventually get people's crypto returned to them, at least at some level, whether it's 70% or I don't really know. I haven't been keeping up with all the details, but it's the money's got to come from somewhere. They need to either be bailed out or they need to have debt forgiven somewhere. It's got to come from somewhere. It's like a house of cards where that you can't just make money out of thin air. And once the market value, the market cap of the crypto market is decreased from $1 trillion of market cap being lost out of the crypto market, a lot of that $1 trillion was the value that was locked in these lending protocols. That's where the value was. It was in that $1 trillion of market cap that's now gone. So it's got to come from somewhere. Hopefully there's some grown-ups in the room trying to restructure and give it the best shot. So yeah, it's an interesting time. It's an interesting time to be alive right now, where we've all decided, and this is why I've always said I stand by this. 100% stand by my claim that crypto is for gains, not passive income. If you think that blockchain is going to be the future, and you want to listen to Weatherman and go with HBAR, you want to listen to Brian Ross and go with Phantom or whatever, like that's fine. That's it's the Wild West. You're speculating on the future of the industry. You're buying crypto, you're hoping to make gains. That's great. That's capitalism. That's as it should be. But just know the difference between capital risk, capital gains, trying to hope that Phantom 10Xs versus putting all of your net worth, all of your hard earned money on a passive income platform where you don't know what they're doing to generate the yield. Just know the difference. That's all I'm asking people to do, is to know the difference. Just know the difference.
It's so true, and the word speculative. Like you and I have had our little debates and stuff about Phantom and HBAR. And the thing is who knows who will be right here in a couple of years, and it doesn't really matter. The fact is I recall when Phantom was running, you were taking profits, and when HBAR, I took profits during that very first initial run. I'm waiting for an extra run. And the thing is it's an investment. Like, yeah, I really like HBAR and the team behind it. But at the end of the day, it's an investment. I'm looking to make money off of this. And I've made videos like when that piggy goes, when that price rise, that piggy's going to market. And I see so many in the crypto space that just dump their whole portfolio in. Most people don't realize crypto is literally maybe 10%, less than that, of my net worth. I have far more in stocks. I actually snagged up the stock Weatherman Twitter handle the other day for when I make the transition over, because I'm expecting it. Of course, some people may disagree, and that's okay. I'm expecting one last leg, but transitioning over, spreading it around and having bets on a handful. As long as you get the fundamentals that are behind each one of your selections, you're likely to have more winners in the long term. But I see it so often, people get really emotionally attached to whatever the crypto is, whether it's Cardano. I saw Doge, a lot of emotional attachment there. You got to take that emotion out if you really want to win in this long term. It doesn't matter, if Phantom had its run, HBAR's had, smaller runs. But got to press the sell button at some point. I think there's a good the HODL phrase, like having patience and letting the market play out, will often reward you. But this HODL mindset for years, when we know that out of these 20,000 cryptos that exist, maybe less than 1% will be around here in like 5 to 10 years. It's really risky to have that mindset in this space.
Yeah, exactly. And that was what was so damaging, I think, about like the marketing for Celsius and Voyager. Unbank yourself, your crypto safe, all this different stuff is like Crypto Weatherman and I know that when we're investing in crypto, we're leaving the safe harbor behind, right? Like we're in the waters of the storm now. We're in the hurricane, and anything can happen. And so we're like, we're not going to put money in here that we need to pay our mortgage or buy groceries, or that's going to affect our retirement. You're like, okay, I'm entering the rough waters now, and anything's possible, and that's okay to do as long as you don't bring the wife and kids with no life jackets and they're going to drown, right? Like you have some, and that's where this whole thing went wrong, I think, with the lending platforms in particular, was people didn't know they were still in those rough waters. They took their profits on Solana, on all these cryptos that did 50x, and then they said, okay, we're just going to enjoy summer and put our money in these platforms and wait. That was a misleading um situation. I'm not saying anyone did it on purpose. I'm not saying anyone's guilty of it. I really don't know. That's for someone else to decide. But there was a certain degree of misleading that was taking place.
I think what 2021 did, I look in retrospect, because I didn't come to crypto until 2019. But in retrospect, whether you caught that first wave or the second wave, it really doesn't matter. But I think back to October, November timeframe where you could throw your money at just about anything. And I think, the percent gains that were experienced during that year has really kind of, I feel like most people were really spoiled in terms of the market. It's like, I've been doing this overall, I've been investing since '07, and I've never seen gains on a percent scale like I did in 2021. And so for those that just came into crypto and got used to 10, 20%, 30% in a day or two, it's unrealistic to have those expectations constantly. Again, it's been about 15, 16 years of investing. That's the first time where you could just, I remember October, November, it was like 800% gains. And I remember contemplating at that time, I was like, the correction for this is going to be gross when it comes along. It's just not sustainable to have that, and that ties into the lending platforms and the APYs that were associated with it. I mean, when you see 10%, 30%, 50%, whatever it is, it's just completely unsustainable. As you were saying, it's coming from this black box that nobody knows where it's at. So
Yeah, that's so true. Something Pablo said, I think, that was really wise, that has kind of stuck with me as we talk about this topic of, it's unsustainable, is when everyone's already talking about crypto, all the banks, hedge funds, your grandma, your barber, everyone's already saying, it's time to get into crypto. Crypto's the way of the future, and the crypto.com stadium goes up, and it's like we kind of reached like a short-term saturation point. Where's the additional market cap going to come from? Where's the, if we're at $2 trillion in the crypto industry market cap, if we want to see a 2x in the industry, then we need to go from 2 trillion to 4 trillion. That's $2 trillion needs to be added. Where's it going to come from if everybody's already all in? Now, I'm not saying it can't get bigger over the next 10 years, 20 years, but in the short term, at the boardroom tables, at the meetings, in, the hedge funds that have money to invest, they've already decided if they're getting in right now or not. Like it's already happened. They've already made their decision. They've already allocated whatever funds they're going to allocate into crypto. There is no more money. And I'm talking 6 months ago now. I realize it's a recession now. Everything's different. Money's leaving crypto. But even back in November, if you really woke up and smelled the coffee, you would have to say it can't go up forever. It's not up only.
yeah, it reminds me of the shoe shine boy indicator. I tweeted about this a few days ago. Shoe shine, like Brian, I know you've been investing for a long time. I've been investing for a long time, and there's a lot of great creators out there. But there's also a lot of them that I scratch my head at, and age is not a discriminator in this space, but at the same time, there's a difference in experience level. Like a lot of these people that are creating content didn't live through the '08 recession. That was something that I experienced. That's something that I attribute into my trading and investing to today. And the shoe shine boy indicator is basically Joe Kennedy decided to sell off all of his stocks right before the Wall Street crash back in 1929. And it was because he was literally getting his shoe shines and he was getting stock tips from him. And, a lot of these young creators have not been through multiple cycles. So they're equivalent, and nothing against a shoe shiner, but, they don't have the experience or the background to really be making calls and picks. And that we were seeing a lot of that, not just in October and November, April and May. I was seeing the same things. It's actually what inspired me to be a creator and start making content. So sometimes Brian and I's, posts and videos aren't necessarily the most exciting or the most thrilling. But there is a difference level in terms of like experience compared to some of the people that we see, particularly on TikTok. I think that's a really, really bad place, even though I post there, but maybe a bit hypocritical. I think it's a really bad place to get kind of like tips in terms of the markets.
Yeah, it is kind of funny that some of the younger creators now have like lost their like luster in some ways, and they're just like back to being teenagers again, And I don't say that with any judgment or whatever. I've learned a massive amount from 20-year-old crypto creators who I mean, I've learned a ton. So I'm not saying who's better or anything like that, but there is downside risk that we haven't seen in the last 10 years because we've been in this permanent bull run with, money printing and everything. And look, I understand why the younger generation sees crypto as their ticket to financial freedom, because it is unfair, right now for the younger generation. When my dad was buying a house in 1960, the house cost 2 times his annual income. My dad was making 30 grand a year and his first home was 60 grand. That's 2 times. So he needed 2 annual salaries to buy a house. Now, you've got people fresh out of college making 70,000 a year, and a starter home in many places is 700,000 or 500,000. So you're looking at an 8 or a 10 um, leverage, or 8 or a 10 ratio between what your annual income is and the price of a starter home in the area where you want to live, where your family is, where your job is, whatever. And people saw crypto as the shortcut to catch up with the boomers. And I get that. And I think it's a huge problem that needs to be solved. There's increasing wealth disparity, but that doesn't mean that you just put your blinders on and you just ignore warning signs and you risk everything you have in speculative assets. That's not necessarily the conclusion from the problem.
Yeah, unfortunately, I the thing is like I believe it will get fixed one day, but that transition of how it gets fixed with the inflation, the home prices, the salaries and stuff, that transition, I don't think it's going to be pleasant for anybody, young generation, old generation, however it pans out. It's going to be gross, and I do agree. Like I kind of feel bad for some of these younger guys that it is a much tougher situation. I think each generation has progressively had it slightly harder financially than the previous generation. But again, like you said, don't put your blinders on. Something that I've picked up, and of course, like I'm not going to say anything, but some of these younger guys, because they did put the blinders on, particularly some of the younger creators, like they're continuing to post content, but I know for a fact that they're broke, because I get these private messages like, "What should I do?" and stuff like that, and I'm like, well, putting it all, your entire portfolio in back in November probably wasn't the best move, but there are ways to accumulate wealth. It just takes time and patience. Like none of this is easy. And I, like you said, that easy route, like if it's too easy, it's not going to last because the market's going to correct that moment. So,
Yeah, that wealth is easy come, easy go for people like that. I mean, they took all the risk that I wasn't willing to take because I've seen things fall apart. So they made more money than I did in the bull run, but then they lost that money because they were still risk on. They don't realize, if their portfolio goes up to, let's say, $1 million or $2 million, they don't realize how life changing that money is. And once you get your first couple $1 million, you really don't want to lose it. That can change your life forever. I mean, that can allow you to control your time, and even if you do have to work, you get to work how and when and where you want, and it makes all the difference. So But they'll learn. There's nothing wrong with being young and learning and adjusting course. It happened to me. It's happened to all of us. It's part of life. And what rich 80-year-old wouldn't give everything to go back and be 20 and poor again? So there's
Yeah.
nothing wrong with being young and learning lessons. There's nothing wrong with that at all. It's all just
Yeah,
part of the journey.
I would pay a hefty sum just to go back 10 years myself, but it's not the way it works. Hey, I was thinking about it. You and I got, there is obviously some mixed reviews. I retweeted your about the ledger. Um, what's your overall thoughts on, should we continue to use that or not?
Yeah, I did a super deep dive on hardware wallets, and um I was being a little bit too hard on them because I wanted to start a conversation. I wanted to poke the beehive and see what came out and see if these diehard, software engineers that just are full on believers in hardware wallets, like if they could defend them. I wanted to see like, okay, let's have some people come to the defense of hardware wallets and answer my questions, answer my concerns. And I did feel like they did a pretty good job of answering the concerns. I mean, one of the risks of hardware wallets is you're trusting a lot of third parties along the way. People say not your keys, not your coins, own your own keys. That's really BS with hardware wallets because some company far away shipped this thing to you and you're trusting that nobody tampered with it, that they didn't have an employee who was working on it at the factory and put some bug in there, some software bug. You're trusting that when the thing generates the key that it has been hacked. And listen, I was vindicated in a huge way because I found out that Trezor, who's one of the major manufacturers, actually has this canary document on their website that they update every few weeks, like canary in the coal mine. And it basically says like we are a major target for financial terrorism and hostile takeovers, and you need to check back. I mean, how many in the audience right now, if you guys are listening, how many of you guys knew this, that you actually are supposed to go to Trezor's website every few weeks and check this canary file to see if they are reporting that they have been compromised or hacked? Nobody knows that. Nobody does that. Nobody realizes that that hardware wallet you have in the drawer in your kitchen might become compromised at any minute by a hack going on at the plant. So it's just not as perfect as you think it is. We would all like to believe that we can just put our crypto on a hardware wallet and never worried about it again. There is some things to be worried about. It's not perfect. And does that mean you shouldn't do it? No, I would still do it. I'm going to still put some of my wealth on a hardware wallet. It's just not reliable enough to put all of your wealth on. And I mean, I somebody call my bluff here. Somebody in the audience here, tell me that you have $1 million on a hardware wallet, because I don't believe it. And maybe if your net worth is 100 million and you have $1 million on a hardware wallet, okay, that's 1%. But somebody show me that you have 80% of your net worth on a hardware wallet. It doesn't exist. People don't do it. That's my theory.
Yeah, I completely agree. Anytime, not just with the ledger, but with even when I'm transferring wallet to wallet, we've been in this for a while, but still to this day, when I'm even like copy and pasting, a wallet address, I mean that whole like evolution right there still makes me sweat a little bit. I do not like it. I think it's very inefficient. And when we think about this ledger, I mean, obviously we have the physical damage, aspect of it. Like I think about if I put a substantial amount of money on there, the thought like I've got two kids running around, and my youngest is dead set on touching things that she's not supposed to. So there's that risk. And then like trying to transfer it back, we'll say in 3 or 4 years, how much is the space going to evolve so that the process that we see today is different? Maybe it's for the better, but still that transfer in that process, again, doing a large sum of your net worth, absolutely terrifying, because once it's gone, it's gone. I mean, that's been a stated rule forever. And it just the fact that the process is so time consuming, I don't see something like Ledger lasting long term. In terms of payments, like if you were to put a substantial amount on there, you would likely be wanting to pull out small chunks to pay for, I don't know, your electric, your gas, your groceries, whatever it may be, and it's not feasible at that point in time. Uh, Part two of this whole mindset as I mentioned earlier about TD Ameritrade and Fidelity, and they're getting their fingers in the pot. Like I see those spaces growing rapidly, and I ask you, Brian, how many of your stocks do you have? How many of your securities do you have on a USB or a ledger? You don't, and it's just not feasible. So as crypto goes into the more of these traditional finance platforms, I think the utility of these cold wallets will be less and less over time. I think personally, I think it's, when you had exchanges disappearing back in the early days of crypto, it made more sense. But I think it's going to make less sense as we progress forward.
Yeah, it's kind of reminds me of like, flying the space shuttle, right? Just because someone else can fly the space shuttle and not crash and go on a successful mission doesn't mean that everyone else is going to want to. And so for you to really learn how to use a hardware wallet and understand it enough and read the documentation and practice transactions and practice your hardware wallet getting destroyed and redeploying your crypto onto another hardware wallet, just because it's possible to do that doesn't mean that everybody's going to want to or be able to or have the time to, especially to the level where they're trusting it with a large amount of their net worth. And so it's not that it can't be done. Flying the space shuttle can be done. And I know people are going to say, okay, boomer, but I'm sorry, like, it's just not going to happen. Even the 20-year-olds, the 30-year-olds, you tell me that you got a, $50,000 end of the year bonus at your job and you're going to put it all on a hardware wallet. Even when you're 20 years old, you're not a boomer, you're a 25-year-old guy. You're not going to do it if you're smart. You're just not going to do it.
Nope, completely agree.
Yeah,
Well, hey, I got to run, Brian. It was good chatting with you, but appreciate the conversation. If you need anything, feel free to reach out, okay?
Yeah, nice chatting with you too. Also, have a great day, man.
Yeah.
I've got to run too, so I'm gonna go ahead and end this space, you guys. But I did set it up to record. So if you guys want to listen to this later, it should be on my Twitter page. But thanks everyone for tuning in, and I hope if you guys had money on Voyager, I hope that you learned a lesson, and I hope it wasn't a very expensive lesson. And I also hope that you get your crypto back, because I do think there's a good chance that, as Crypto Weatherman said, as they go into reorganization in bankruptcy, hopefully they'll prioritize their customers and everybody will get something back. But thanks again, everybody, for listening. Hope you guys all have a great day.
Thanks. Bye, Brian.